Good morning, good evening, good afternoon. With Sensenchange, your host, Charles Alford. We are here with Sensenchange again. So last week we did the pilot video. This week we're gonna do a little bit talking about accounts just to get the foundations down packed. So just to give you a little bit of background, I worked in retirement, worked on Wall Street, worked for the New York State Comptroller's Office. So a lot of these things, I'm telling you, it's because we first got to get the foundation before we just jump right into making money. Just to start off, the number one account that we have to have is definitely a checking account. The reason why you have to have a checking account, pay your bills, etc. I won't even bore you with the details. The second account that we have to have is a savings account. We all know why it's important to save. Whether it be for a home, your kids, your family members, medical expenses. There's a lot of things that you can tie into that. One more thing with the savings account, the type of institution that you in give you the safest but also the highest return on your APY. So it's just the interest rate that you receive for you putting your money into that account. The next account that we're going to jump right into is that you should definitely have a miscellaneous account. So a miscellaneous account is for things like travel, things like just random expenses that you're not expected to have. And I know some of you like, hey, so why don't you put the money from your upcoming expenses into your savings account? So the reason why you don't want to dip into your savings account for no reason is that as you grow more money in your savings account, it's going to accrue more interest on it. So when you take from that, you're not going to accrue as much money over time. For example, let's say that you put $1,000 per month into your savings account. So with a return of, let's say 1%, you're gonna get $10 in your account, every time the interest rate comes out. But the second that you take from that 1,000, so maybe it's only 500 this time, you can see that off of just that specific time that you're taking out is only gonna be $50. So this is why you really don't wanna touch any money into your savings account, and you really wanna let it build. Which ties into this next account that you should have is a brokerage account and a retirement account. So those are the fourth and fifth accounts. So those are the top five of this account. So the retirement account and the brokerage account, they could go hand in hand. Why I say that is sometimes if you have a job and it has the retirement account that you're set up with, sometimes it could be an investment bank that you have it with also. And you can sometimes transfer any monies that's above the retirement threshold into your brokerage account. So what do I mean by this? So let's say, for example, you have a 401k with your job and you work at Vanguard. So I believe right now or last year it was at $20,500, and I think this year is at $22,500. That amount is the contribution max that you can put in for the year, assuming that you're under age 55, I believe, somewhere in the 50s, that you're not over that age threshold. And when you're putting money into that account, if you go above that, typically you'll get taxed on that amount. So that extra amount have to go somewhere. So what they may do is that they may transfer, let's say if you reach 30,000, that any amount over the 22,500 will go into your brokerage account. Now, the reason why the brokerage account is very important is because this is the money that I'm going to be talking about with the stock investing to grow your wealth. And another reason why this account is important is that this account, you will be able to withdraw or deposit as much as you want. Yes, if you withdraw, you'll take the taxes on it. You'll take a tax hit for capital gains, depending on if it's over a year or under a year. We'll get into that in later videos about taxes, but that's the reason why you would want to touch your brokerage account and not necessarily your savings account. The reason why I'm saying these specific accounts, because of what a lot of people do is that they touch in their savings for any miscellaneous expenses that they're not expected. Oh, the car, my tire pop. I gotta dip into the savings. I wanna go out to eat. It was more than my budget. I'ma just transfer from my savings. So that's exactly why I say you would want to have the miscellaneous account to dive back into rather than your savings account. And these accounts that I'm talking about, you can have multiple accounts with the same institution. But what I recommend for your checking account, and especially where you have your credit card at, because sometimes your checking account and savings account is tied in with your credit card, you should have your credit card with the same institution that you have your checking with. It's so easy to get lost in how much money you have to pay to your credit card so you don't get charged interest on it every upcoming date that you have to pay your credit card bill. So by the push of a button, you could just transfer money from your checking to your credit account. You don't owe any debt, which is what we don't want. Now, just another tip for your checking account, savings account, and credit card. For those two accounts with the credit card, you would want to have a credit union versus a commercial bank like a Chase or Bank of America. In life, we get into sticky situations that we're not expected to. And let's say if you leave a balance on your credit card, you're gonna have to pay interest on it if you don't pay it right away, and assuming that you don't get a 0 API for the first 15 months that you purchased the credit card. Now, it's important because we want to have more money in you guys' pockets. So let's say you leave a $1,000 balance on your credit card. Let's say you pay for some, college expenses or something with your car, because that's the two most common areas of why balances get left on credit cards. Now, what you would really want is to find out which one has the lower interest charge. Now, for a credit union, typically on average, they're gonna have a lower interest charge versus a commercial bank. And just think about it fundamentally. Banking institutions are for-profit institutions. Working at a Chase, Bank of America, Merrill Lynch, these institutions are for-profit institutions. So on average, for every of the for-profit institutions, they're gonna have a higher interest charge balance rather than credit unions, because credit unions are either not-for-profit or non-profit institutions. On average, when you change and look at the interest charges, you would rather want to get a lower rate on the interest charge than a higher rate. That saves you more money in your pocket. I'm trying to do the videos under 10 minutes that way, because I know you guys have a lot to do. You have very busy lives. And I just want to give you information before the 10-minute mark. So I thank you again. And we'll definitely get back to another video with you with more information. Go to the website, sensenchange.us, sign up for a consultation, one-on-one or group. Please follow me on Instagram. Please follow me on Facebook. And thank you again. We'll be back with another video next week. All right, bye-bye. We're definitely going to get into more things in the more upcoming videos. Please check out the website, sensenchange.us. I'll put it under the screen right here, sensenchange.us. And also check out my YouTube channel. Please like, comment, and subscribe, guys. Thank you, and we're going to get more into these videos. All right, bye-bye. Sense and Change, your host, Charles Alford.